again, everybody. Mike Loukas, CEO of TrueShares. Welcome to another episode of Off the Charts. Today, we've got a very special guest, someone that's near and dear to my heart, and I call El Jefe, Jeff Feldman. Jeff, welcome.
Thanks, Mike.
So, Jeff, you are a quantitative risk manager, I think by trade, but you are also a portfolio manager of several of the TrueShares ETFs that contain derivatives. And I think that it would be fair to say that you are not only our in-house options expert, but have created an entire career out of the options world and the options trade.
Yes, I love the business. So I really started working in the industry when I was 16. So I started at 16. I was taking the train to the options exchange and I was worked there for six years every single summer of my high school career, college career. I worked at the options exchange and I would float in between the options exchange and the mercantile exchange and the board of trade in the bond pit. So really getting a major flavor of the industry at a very young age.
Yeah, I think I was a lifeguard
Yeah.
at that age. Maybe I was on the grounds crew of a golf course. It was one or the other. So yeah, you definitely have a passion for the business. And so this
We,
it's
we, we
been
we might have been getting paid the same though,
yeah,
unfortunately.
right, right, fair enough. So this was, I don't know what, 25 years ago? How long you've been in the business? 25 years plus?
Yeah, so this was in, yeah, 94.
90, 94. Yeah,
94.
so we're 30 years at this stage.
Yes.
Yeah. Okay. So you've got lots of stories about the evolution of the trading desk and the trading floor, I'm sure.
Yes, really back then there were no electronic networks, right? Everything was on the trading floor, and
The trading floor ran on caffeine, cigarettes, and people yelling at each other.
yeah, absolutely. It
Yeah.
was it was a lot of fun. There was still talk to people to this day, from
Yeah.
30 years ago. It was a lot of camaraderie that was on the trading floor.
Yeah. No, I bet. I bet. Sounds like an amazing environment. Um, so look, we could talk about your career all day, and I'm sure we have plenty of stories we could talk about that maybe shouldn't be recorded. But look, let's get into the topic for the day, which is derivatives, which is the idea that historically people have always said, "Oh, you use derivatives for hedging," and I think there are a myriad of other uses for derivatives. And again, we could sit here all day and discuss them, but let's take it, on the pretty high level and first and foremost, get your opinion as to why derivatives have become so popular in the ETF wrapper these days.
Sure. Well, I like back on the trading floor, it was I would say a very large institutional client base. It was just international banks, local banks, just kind of hedging their portfolios. And it was options were just really considered for the very savvy, sophisticated investor. It was hard to get involved in options. You had to have a separate brokerage account, and it was very difficult to get in the game, so to speak. And really, over the last like couple decades, there's been uh, a, a a a yearning by the public to learn more about the topic, and it's being offered from Robinhood and Schwab and Fidelity are offering teachings on options on their platforms. So the individual investors are really learning how options work, how they can be used in their portfolios, and they're learning about it. And they are becoming very involved in options and really almost like leading the market and having more of a force than the institutional side.
So it's really been, I guess, two factors. If I'm going to distill it down, two factors, right? One is um, the democratization of the actual contract. So now you can trade them. Now you can actively access derivatives contracts in lots of different forms. But the other is the education, right? It's understanding how to utilize them. And I'm sure, like with any other product in our world, that education is ongoing, and some people utilize it, some people don't, which is, a frustration in certain circumstances. But the education and the access, right? Put those two together, and we've taken strategies that have been around for decades in the institutional side, and we've democratized them into the ETF wrapper and made them hopefully more investor friendly and increase the usability, if you will.
Yeah, and really the ETF wrapper has allowed investors to have these more complex strategies that might be more difficult to execute on a retail platform, which you're kind of tying in with the us, being a more institutional player and being able to tie into that side and being able to trade spreads very conveniently, put it in the ETF wrapper. So it's tax efficient. It has the outcome that you are looking for, and there's this like ease of use for the end user. So you still might, I think there's still like lots of very sophisticated retail investors who are using options themselves and are overlaying these ETF wrappers in their portfolios, allowing them to have these complex strategies.
So layers of depth for, all sophistication, layers of investors, right? So we've got turnkey solutions where someone like you and TrueShares, for example, will deliver a derivatives-based outcome strategy to the marketplace. And then certainly folks that are deep enough in the education of it and understanding that they can execute these and create some strategies on their own as well. And sometimes a combination of the two.
Yeah, I think there's probably a lot of combination of the two that is being utilized by the public. And even
Mhm.
investment advisors now are using them in their repertoire, so to speak, because now
Yeah.
the clients are more sophisticated in understanding how these products work and have a comfortability to having them in their portfolios.
Yeah, no doubt about it. I mean that the AUM attributed to derivatives-based product has obviously gone meteoric, in the past, call it half a dozen years or longer, I guess. But uh, in the perspective of what we do, very recently has as a lot of the active derivatives-based space uh, gotten tremendous traction in the ETF world. Which leads me to a couple of questions. One is, uh, what is in your 30-year history, including your high school days, in your 30-year history, running trading strategies and in particular option strategies, what has been your favorite derivatives position or approach uh, historically?
Oh, sure. One thing that when you're watching CNBC and it's earnings season and NVIDIA is about to have an announcement, and Jim Cramer is interviewing someone who has a little bit options experience, and they say, "Oh, Nvidia is going to move like 12% or 15%." The marketplace is implying a 12 or 15% move with this earnings announcement, and you're like, "How is this possible? Where is this guy getting these numbers from?" And what they're doing is they're actually looking at the options marketplace. So the options marketplace is just, it's a all the buyers and sellers are kind of coming together at the money straddle. So if a stock is trading at 100, the 100 strike would be where everyone is kind of coming in with that would be the at the money straddle. So if the in this example, if the call is $6 and the put is $6 at the money, the marketplace is implying a $12 move. $12 divided by 100 would be 12%. So in this example, the marketplace would be implying a 12% move in NVIDIA over this time horizon. I think that is like uh, you know, that's very efficient, that at the money straddle, all this money is kind of coming in at that value. And the straddle is kind of implying like a one standard deviation move, which would be about so 70% of the time it should fill in that gap. So if you were thinking of like a trade to do, around that earnings release, going up, if you would to, if you're long NVIDIA, for example, and the marketplace was implying a 12% move, selling a call up 15%, so at like 115 would be considered like an edge trade.
So you get two components of it, right? One's sort of the fair value of the trade and how efficient the pricing is. And two, if that pricing is disjointed, there's edge, right? There's edge in the trade.
Yeah, absolutely. So
Yeah.
without using a anti-Black-Scholes model, just really looking at the straddle, and seeing this is what the marketplace is saying. This is everyone is kind of coming together, and I'm getting my fair value from the marketplace and kind of like going out from there.
So let the market dictate the fair value, and you can judge what the odds are, right? Or the probability is of that fair value delivering.
Yeah, like if the marketplace is kind of coming in, and normally that NVIDIA earnings is 12%, but not maybe now it's pricing a 30 or 40%. You're like, wow, that seems like a lot.
Yeah.
Volatility is really expensive. So in that case, maybe you would sell if you could sell that $150 call, be like, wow, that's pretty expensive. But that would give you comfortability, kind of showing like, you know what, I don't know which call to sell. I wanted to sell something or buy, but well, in this case, we'll say sell. You wouldn't want to necessarily sell the 125 if they were pricing, the Strata was pricing in, like a $50 move. You can kind of get more premium with a bigger buffer, so to speak.
Right. Right. Well, I mean, from my perspective, and I'm not as nearly as quick on these as you are, but from my perspective, the idea that there's all of this is supported by math, right? I think, when you come from the equity side of the world, in a lot of cases, fundamental research or tactical research or technical research, when you get to the options space, it's even surprising to me sometimes how it's really all math and figuring out fair values and assessing the probability of those fair values being accurate.
It is all math, and it is being done by supercomputers that these market making firms are investing tens, if not hundreds of millions of dollars every year in making things very, very efficient and very, very fast. So their computers are calculating, you know, every strike, every call, every put, every month, all the way down the spectrum, and then changing their prices every single time. Apple moves 1 penny, and they're changing all those prices, and then multiplying that by like all these stocks. So you have a lot of supercomputers and computer power, being used to update like this whole entire marketplace, and that could just be one firm, and now you have dozens of firms kind of making it very, very efficient. So the electronification of the marketplace has made
Mm.
things massively efficient,
Yeah,
which
well
is
put.
just a huge benefit for investors.
Yeah, yeah, definitely. Well put. Well, look, Jeff, I promised I would only take you away from the screens for 10 minutes or so. I think we're bumping up against that. So I hope everybody enjoyed access to our supercomputer, Jeff Feldman, affectionately El Jefe. And Jeff, I get to talk to you every day, but I'm glad we have a little time here to show the audience what's going on behind the curtain. And we'll have you on again soon because I think this is a substantive and useful conversation for people to see.
Yeah, great, Mike. It was a pleasure to do this with you. I had a
All
lot of
right.
fun.
As always, bud. Thank you.
Thanks.